Assalamualaikum and Salam Sejahtera. This video is to explain on the redemption of redeemable preference shares and also redemption of debentures. First, we look into redemption of redeemable preference share. The redeemable preference share is actually categorized as non-current liability. This is according to Malaysian Financial Reporting Standard 132, saying that it is a debt to the company because the nature of redeemable preference share, whereby the company is obligated to redeem, to pay back the preference share at a certain time. But it's different with the ordinary preference share, whereby the preference share, the company is not obligated to pay back the shares at a certain time. So that's why preference shares category as equity, but the redeemable preference share is categorized as non-current liability. And according to Company Act 2016, in the section of 72, the redemption exercise must be notified to the share registrar within the 14 days of the exercise. And the rule of redemption, first of all, the shares must be fully paid. And the second one, it can be done by issuing a new shares, because to redeem preference share, we need fund. So the company can issue a new shares to fund the redeemable preference shares. The second method that they can use is using the retained profit or using the capital. You must be curious what is the share registrar is. So actually the share registrar, it is a company or a bank, still a company, that is responsible for record keeping of bondholders and shareholders details, such as who are the one who held the shares, how many units, what are the registration numbers, and so on. In Malaysia, there are the two examples of share registrar is Security Services Holders Sdn Bhd and also Plantation Agencies Sdn Bhd. You can Google them and look into their company's profile. So the redemption using capital, this is a bit tricky. When we try to understand it, it's quite confusing. Okay, the redemptions of using capital, the first of all, company must have more than sufficient to fund the redemptions. So if the capital is not sufficient to redeem the preference share, that this cannot be done. So in the rule, Companies Act 2016, section 72, clause 6, saying that all directors must have a solvency statement. They must make a solvency statement, which is fall under section 1113. So the directors must have that declarations. The company is solvent, will not be bankrupt in in a year after the redemption exercise. And also the company must submit a copy of that solvency statement to the registrar, and the statement the solvency statement actually must essentially confirms that the company will be able to pay its debt within 12 months of the redemption. If the creditor asks to pay within the 12 months, the company's capital should be sufficient to fund paying the debts within the within the 12 months of the redemption exercise. So meaning that the assets of the company is more than enough to cover its liability at the date of redemptions. So those two things that must be have in the solvency statement. Okay, we look into the redemptions through issuing new shares. For example, we have this example, the per heart, where we have the extract statement of financial position as at 31st December 2017. Now, so we have the non-current liabilities, 6% redeemable preference share capital, which is at 12 million. So let's say we would like to redeem the preference share, all the preference share. So on the 1st February, and in the purpose of redemption, company issued new ordinary shares at the price of RM1.50 per share, and this ordinary shares issuance will be payable in full upon the applications, and the issues was fully subscribed on 30th March 2018. So the redemption is actually on 2018, but this one is the last year, I mean the statement of financial position last year. So we from the questions is that the total, the money to pay for redemption is 12 million, because we look here at the bottom, the non-current liability, the value of 6% redeemable preference share is 12 million. So these are the total, because we want to redeem all. So 12 millions. And for the purpose of redemption, we issue new ordinary shares, and the price of ordinary shares is RM1.50. So to fund it, the 12 million, the value of redeemable preference shares, so 12 millions divide with RM1.50, so we actually will issue 8 million units of new ordinary shares. So these are the calculations that you first need to do from the information given. So your journal entries from the example just now, okay, we will have to pay 12 million to redeem the preference share. So the journals on the 1st February, we debit 6% redeemable preference share capital, 12 million, and we credited the preference share capital redemption account, whereby the preference share capital redemption account is actually a temporary account. So by the end of the year, by the end of March, because we already have the money to pay, so the preference share capital redemption will be debited, and we credit our bank account as the payment to redeemable preference share shareholders. So the records, the journal entries for the next one, for the issuing the ordinary shares, okay, the new ordinary share price is 150, so we issued 8 million units. So we have debited bank account 12 million, because we issue 8 million units multiplied with the price RM1.50, so we have 12 millions, because this is the fund that we need to pay our redeemable preference share shareholders. And then we will credit the ordinary share application as usual. Remember, the last lectures how to record the issuance of shares. The same goes with debit bank, credit ordinary share applications, and recognizing the share applications to the share capital. So debit ordinary share applications and credit ordinary share capital. So the records, okay, we have total to pay 12 million. So the bank would be deduct with 12 million, and then we add up with the 12 million because we have the new fund. So the bank account value is not changed actually, because we already received 12 million and pay out the redeemable preference share 12 million. So the bank will be remain as 33,100,000, and the ordinary share unit from previous statement of financial positions, we have 20 million units of ordinary shares, and we have issued the new one, the 8 million, the new issuance of shares. So the unit has been increased to 28 million, and the ordinary share value from last year we have 40 million ringgit, and add up with the 12 million because we issue the 8 million, the 8 million units multiplied with 1 ringgit and 50 cents, so we have 12 million. So the value of ordinary shares has been increased to 52 million. So your statement of financial position, taking account the information of redemptions and the issues of new shares, so your statement of financial positions, the bank account is not changed, but the equity, the ordinary share from 20 million has been increased to 28 million of units, and the value increased from 40 million to 52 million. That's the records should be for the redemption using the issuance of shares. So the redemptions using retained profit. Okay, we use the same example, dear Perhat. So if we redeem the 6% preference share using its retained profit, so again the total to redeem is 12 million because we look into the value of redeemable preference shares, and we need to deduct the retained profit from 23,750,000, deduct with 12 million, so it becomes 11,750,000 if we use the retained profit. So the records, the general entries for redemption using retained profit, again we redeeming the reference redeemable preference share capital. So we debit the redeemable preference share capital and credit preference share capital redemption account. Then we need to pay out the shareholders, so credit bank account and debit preference share capital redemptions. And we need to adjust the retained profit because we use retained profit to fund preference share capital. So you debit retained profit and debit the ordinary share capital. Okay, this is the last part, is actually to maintain the capital. So capital maintenance we will discuss on the next lecture because it's quite a lengthy argument. We need to reimburse the share capital because we do not want creditors to presume that your capital has been reduced. So the records in the statement of financial positions, once you redeem using the retained profit, again the information that we have is bank account should be deducted with 12 million, and the retained profit is to be deducted with 12 million. So your statement of financial positions, bank 21,100,000 and retained profit 11,750,000, and the ordinary share capital is increased from 40 million to 12 million, becoming the 52 million ringgit. However, the ordinary share capital units is not changed, still at 20 million, only the value. This is because the capital maintenance exercise. Moving on to the next redemptions is the redemption of debentures. So the payment to debentures holders can be in lump sum, one-time payment, or can be on installment, but we need an agreement with the debenture holder whether we can do one or two. Okay, then the redemption value can be at par, at discount, at premium. Normally, the redemptions are at the price displayed or presented on the statement of financial positions, meaning that we only pay at the carrying value of the debentures. We look into the examples of redemption to debenture. Okay, let's say we have the same example from previous slides. So the perhaps statement of financial positions at December 31st, 2017, we have 8% debenture, 10 million. So on the 1st of July 2018, the 8% debenture was redeemed because it's already matured, and the all interest was due in 2018 was fully paid. So meaning that the value to redeem the debenture is 10 million because the interest has been paid. So total money to pay for the debenture holders is 10 million. So we only took the bank account, deduct with 10 million, so the bank account will be reduced 23,100,000. So the journal entries and records of debenture redemptions, using that information, total money 10 million to be paid. So your entries will be debiting the 8% debenture account, meaning that we will close off the debenture accounts, and we no longer have debenture, and we credit the bank account the 10 million value. Non-current liability, the debenture account is gone because it's already paid, and the bank account reduced to 23,100,000. Okay, that's all for now. Redeeming the redeemable preference shares, and also redeeming the debentures. See you on the next video.